So, Matt, I got to say, I was there watching it through the midday. We were joking earlier in the morning somewhat, hey, watch, this market's going to shake it all off and finish in the green. We didn't think it would really happen. This is a bulletproof market, or is it not?
Well, that's the problem, is that sometimes the market seems bulletproof, but it never is. There are always times when the market pulls back. And I think yesterday showed that there's a little too much complacency out there. I mean, for a significant uncertainty to re-enter the marketplace after such a big rally. I mean, everybody talks about 28% last year, but it was really 38% from the previous Christmas day. I mean, Christmas Eve of 2018, a 38% rally, and just 12% over just the last 3 months. The market getting overbought, and this is, I think, significant news, and I think the market needs to pull back a little bit. If nothing else, I think the upside is going to be somewhat limited. So people with new money, like their year-end bonuses or whatever, they want to put that to work. I think they can a little bit, but they want to jump in with both feet. Keep a little powder dry in case we do get a more sustainable pullback than just the 1% we got for a day and a half there.
Matt, this is not because I'm a bull. This is not because I'm a bear. This is just because I'm a market observer. People have been saying that this market is due for a pullback for the better part of a year now, and yet it's never really happened. We've gotten some real kind of maybe looks at them, but they haven't really had that opportunity to step in and buy. What exactly takes this market down if it's not the threat of a real conflict in the Middle East?
Well, a couple of things. I think number one, could be interest rates. The thing that we're seeing here is that even if the economy doesn't improve, and this is, I think, the key point, we're seeing interest rates around the globe move up, long-term interest rates. In Europe, we have whatever we had, like, the German bond was at a deep negative rates were quite deep. Now it's almost back to positive rates in Germany. And the number, it's gone from $17 trillion of negative interest rates, and it's now down to 12. See, interest rates are moving up. That's one of the reasons interest rates overshot to the downside last year in the U.S. So as global interest rates move up, they, I think, will move up in the U.S. even if the economy doesn't improve. And, of course, the other thing is earnings. We had earnings last year were zero. I mean, basically flat for 2019, and yet the market rallied as strongly as it did. As we get into earnings season, if we don't get guidance, it makes it going to look like we're going to have a really good year. It's looking for 8 to 9% growth. At that, everybody is always too high at the beginning of the year. If that comes into the mid to low single digits as we go through the year, that's going to be a problem.
Do you believe, then, that interest rates really are heading higher? And what's going to be driving that overall?
Well, two things. Number one, like I said, if the situation in the Middle East blows up, interest rates will go down, but the market will go down with it. If obviously in a flight to safety trade. But I do think it has to do with what's going on with Christine Lagarde. She is a very respected person taking over at the ECB. She is pushing for interest rates to move higher and move away from negative interest rates in Europe because it was absolutely killing their banks. As those interest rates move up, that our interest rates become less competitive, and so therefore they can move up as well. People won't need to have come and buy U.S. bonds as much as they had. So when people talk about, geez, it's going to be rates are going to go higher, so therefore it's going to be fine because the economy is getting better. They can go higher for that reason, just like they went lower for that reason last year.